Hey everyone, welcome back to Corporate Decoder, the place where we decode the boring stuff so you don't have to. Ever wonder what secrets hide in those massive corporate reports? Today, we are diving into Wisconsin Electric Power Company's latest filing, and trust me, it's more than just numbers and legal jargon. We are getting into their power plans, their profits, and yes, even how green they are trying to be. Let's start with the big picture. Wisconsin Electric Power Company, or We Energies as they like to be called, is telling its preferred stockholders about their upcoming annual meeting. But this isn't just a friendly invite, it is a peek into the company's operations and financial health. Right at the beginning, they mark this as a definitive information statement. Think of it as the final official version, not just some draft or a we might do this kind of deal. This filing tells stockholders who's up for election to the board and what they'll be voting on. Here's where things get interesting. Wisconsin Electric is part of something bigger, the WS Energy Group. And guess what? WEC Energy Group owns almost all, over 99% of Wisconsin Electric's voting stock. So while there's a meeting for all stockholders, the parent company really calls the shots. They are holding a meeting with the main item on the agenda being to elect 5 members to the board of directors to hold office for another year. If you're a stockholder and want to actually show up, you'll need to contact stockholder services. Don't expect any juicy updates or Q&A sessions. It is mostly a formality. The company's annual report is attached, meaning this filing comes with a hefty dose of information on how they performed. Always important to look at that report. All those materials are online for anyone to see. It's 2025 after all. So who gets to vote? As of March 7, 2025, Wisconsin Electric had a mix of preferred stock and common stock outstanding. Each share, no matter the class, gets 1 vote, but since WEC Energy Group owns almost all the common stock, they basically decide everything. Time for the election of directors. The Corporate Governance Committee makes recommendations, and the board then nominates people. Interestingly, all the nominees are already officers of the company or WS Energy Group, so no outsiders here. They have a handful of specific skills they want each director to have, including proven integrity and sound business experience. Here's a quick rundown of who they picked. We've got Michael Hooper, the president of Wisconsin Utilities with experience at another utility company. Then there's Kyle Hoops, the senior vice president of power generation, a utility operation veteran. Margaret Kelsey, the legal expert as executive vice president, general counsel, and corporate secretary. Scott Lauber, the president and CEO of WEC Energy Group with a long history at the company. And finally, Sha Liu, the CFO with a strong financial background. Since Wisconsin Electric is wholly owned, it doesn't have its own committees. Instead, it relies on the WEC Energy Group board committees, like the Audit and Oversight, Compensation, Corporate Governance, and Finance committees. These committees handle everything from financial statements to executive pay. Since the board members are already senior officers of the company, they aren't getting extra pay for being directors. It's all part of their existing compensation packages. Nothing else major on the agenda, just the usual anything else that comes up clause, but don't expect any surprises. The corporate governance section is always a wealth of useful information for things like how directors are chosen, and even whether or not they can use the company's stocks for betting on the market. They can't. The company has an insider trading policy, so its leaders can't trade on inside information and get an unfair advantage. Think of it as thou shalt not cheat with company secrets. They also have a code of business conduct, and anyone who violates it can confidentially report it to a third party. Ethics are always in season. Yes, to all the transparency and accountability questions. The audit and compensation committees are squeaky clean. The CEO's office is combined with the chairman of the board, and the company has a system in place to evaluate corporate risk. Deloitte & Toussell has been the independent auditor for over 2 decades. This section is important because it discloses not just the amount, but what those auditors were doing. They paid nearly $3 million for audit services, a bit over $70,000 for tax work, and just a hair over $1,000 for stuff like accounting seminars for employees. The Audit and Oversight Committee basically gives the financials a thumbs up, saying everything is in order and ready to be filed with the SEC. Now let's talk money, specifically executive compensation. This section dives into how the company pays its top executives, what they get, and why. It's a good place to understand where the incentives lie. A big point here is that most of the CEO's pay and the other executives is tied to performance. This means that if the company does well, they get paid well, but if it doesn't, their paychecks take a hit. They have also done engagement with investors to ensure the compensation practices are responsive to stockholder interests. In other words, to make sure the investors are happy. The company benchmarks itself against other similar companies. They want to know what the market rate is for their executives to stay competitive and attract the best talent. The annual base salary is the fixed cash amount an executive gets and is determined by experience, performance, and market data. They provide annual cash bonuses under something called the Short-Term Performance Plan, or STPP. It's all about hitting those short-term goals. If they hit the goals, the executives get a bigger bonus. If they don't, the bonus shrinks. Their goals are linked to sustainability. Their financial metrics also reflect their environmental goals. So how did they do? Pretty good. They exceeded customer satisfaction goals. WEC scored big on customer happiness and diversity. Not so much on safety, which was in the middle. All these factors affect how much the executives get paid. Besides the short-term bonuses, there are long-term incentives. This involves things like stock options and restricted stock, all designed to get the executives to think like long-term owners of the business. The long-term incentive awards are weighted 65% performance units, 20% restricted stock, and 15% stock options. This helps executives focus on the long game and be less risky to try and maximize short-term wins. The compensation committee adjusted the payout for companies with significant underperformance. In the end, the performance units vested at 112.9% due to peer review of their returns. The company requires its senior executives to own a significant amount of company stock. The guidelines require each executive to acquire stock having a minimum fair market value, ranging from 250% to 600% of base salary. The executives aren't allowed to hedge or bet against their own company stock. They can't enter any arrangements that obligate the company to pay directly or reimburse individual tax liability for benefits provided. Alright, let's get to the money. This table shows how much each of the top executives made. The table summarizes the pay of the company's CEO, CFO, and other highly compensated executives. For example, the CEO, Scott Larber, made over $10.90 million in 2024. This table gives a look into what they might earn based on future performance. For instance, there are potential payouts under the non-equity incentive plan awards, which depend on how well the company does against its targets. Here's a look at the options and stock that the executives have waiting to vest. It gives a sense of the potential wealth tied up in the company's future success. The company has a policy on when they grant stock options, and it's designed to avoid any hint of timing the grants with inside information releases. Here you will find the process used to identify director nominees and how to recommend a nominee to WSC Energy Group's Corporate Governance Committee if you want it. Deloitte and Turltail served as the independent auditors for the company, and they've been selected as independent auditors for the fiscal year ending December 31, 2025. There were roughly $2.8 million in audit fees. There were also some tax fees and seminar costs. The compensation committee basically signs off on everything, saying they've done their due diligence and believe the pay packages are fair and aligned with company goals. These table details total compensation awarded to, earned by, or paid to the company's chief executive officer, chief financial officer, and other top employees. Here's the breakdown of how much the company paid Deloitte and Touche for audit, tax, and other services. This is the company statement ensuring equity awards are timed fairly and not based on inside information. Let's not forget about the shareholders in this section. We can see how the company did from a stock performance perspective. The fees that the outside auditors charge for their services is anything that might come up at the meeting. We get a peek at the compensation for all the top executives, their salaries, stock awards, and other goodies they get. This section tells how the executive salaries are determined. Audit committee gives the thumbs up, meaning all the financials have been reviewed and in good order. And this corporate governance section answers some of the basic questions. Do they have a code of ethics? How are the directors chosen? Etc. Fees paid to auditors for their services. How does the company determine pay packages for executives? Overview of company pay strategies, what they do for executive compensation and what they don't do. List of companies in the competitive peer group. Summary of stock option awards and other long-term plans. Here's who owns what in terms of company stock. Grants of plan-based equity awards. Summary of all equity awards, including the potential payout. Fees paid to auditors for their services. Frequently asked questions on how the company is run, and there you have it, your peek behind the corporate curtain. So what's my take on all of this? Chemcar, Wisconsin Electric seems to be running a pretty tight ship. They're hitting their marks, investing in cleaner energy and keeping their customers happy, at least according to the surveys. The high percentage of performance-based pay for executives suggests they are serious about aligning management's goals with company success. The shift towards renewable and natural gas and battery infrastructure makes them competitive with the rest of the green energy push. The biggest opportunity is making the company more efficient. They are still lagging behind and could use some focus. They are also pretty heavy in debt. However, they seem to be playing this all by the books. So is Wisconsin Electric a powerhouse or a paper tiger? Definitely a company making smart moves for long-term success. They are setting the stage to be a key player in the future of energy, but are taking on some risks on the way. That's all for today's Corporate Decoder. Hit like, subscribe, and let me know what corporate report you want me to decode next.